It's time for Credit Puppet.
Hi, and welcome to the 4th episode of Credit Puppet. Rusty, can I ask you a question?
Sure, go ahead, CP.
With all of your credit expertise, couldn't you save a little bit of money to pay someone to be the clock guy?
Well, you know, with the economy bad and everything, CP, we got to save some money. So maybe when we get a little bit more money doing these episodes, we'll hire someone to do our clock for us.
Okay.
But anyway, today we're going to keep on going with our ongoing series on credit scoring. Our last episode, we talked about payment history, which is 35% of your credit score. Today we're going to talk about the second biggest factor in your credit score, which comes down to amounts owed. And that's really having to do with the debt that you're carrying on your credit report. Debt is a very big factor in how people see you as far as risk goes on whether they're going to give you a loan or not. Debt, being the second most important thing, is considered by lenders and the banks as a very good predictor of risk. If you fill out a credit application and they pull your credit report and you do not have a lot of debt, they obviously know that you don't have a lot of money going out to your other debt, so they know you have money available to pay this new debt. So that's why it's such a good predictor of risk. So if you go in and fill out a credit application, CP, and you have a lot of other debts you have to pay, it's going to make them think about wanting to give you more because they know you only have so much money at the end of the month to pay all your bills. So that's why amount owed is really such a good predictor of risk.
That makes sense, yeah.
Yeah. So, and especially now that the economy is the way it is, if you have more debt, you're probably even more susceptible to being cut down by having some high debt. Then when we talk about credit reports, there's actually two kinds of debts that they actually look at. One is installment debt, and those are loans like your car loan and your mortgage loan, where every month you have a fixed debt that you know you have to be paid. And that debt is not looked at as bad as revolving debt. Revolving debt can really affect your credit score and your chance of getting new credit. And revolving debt is credit cards and home equity lines of credit. And revolving CP simply means that your credit balances and your payments amount, because you can put new credit on and pay more, so your bills are constantly revolving. There's not a fixed amount of debt, and that's why the creditors look at that as a more important factor of whether they're going to give you a loan or not. So the rule of thumb we tell our clients and our viewers here on Credit Puppet is you want to keep your revolving debt or your credit card debt below 30% of your credit limit, and if you do that, your creditors will look at you a lot better.
So that means you can basically handle your business if you can keep your credit like that.
Absolutely, absolutely.
Okay.
Not only do they think you can handle paying your bills, but they also see that if you're below 30%, that you have 70% of your credit available. So that means you're not you're not irresponsible or running out to the mall and buying everything on the mall just because you have some absolutely open credit on your credit card. And like I said, you know, when we're in tight financial times or where we are, the banks are actually looking to cut some credit back. So if you are carrying a lot of debt right now, some of the big banks are actually looking at people and cutting those credit limits back down because they don't want to get in trouble with those people. So there's a lot of people whose credit scores are going down because, let's say somebody they're using 50% of their debt. The credit card company may go, okay, this guy has a $10,000 limit. He's got a $5,000 balance. We want to make sure he doesn't get over his head. They cut your credit limit from $1,000, from $10,000 down to $5,000. Now on your credit report, you were at 50% usage. Now you're at 100% usage, and your credit score drops. So that's one thing that's happening to a lot of consumers around the country.
Is there anything you can do if that happens to change your credit report?
You can call the bank and see if you can negotiate with them, but right now you're probably not going to have much of a chance. That's just the way that the bank and the credit card companies mitigate their risk.
Okay.
Because remember, credit card debt is unsecured. If you don't pay it, there's no way for them to get that money back except to send it in collections and
fight for it.
Absolutely. So they're trying to keep from having more losses than they already have. And that's the main reason they're doing it. They're not really doing it to hurt their consumers, but they are hurting their consumers, but they're trying to protect themselves as well. So in a way, it's not good for consumers, but you can kind of understand why they're doing it.
Yeah, it's a little CYA.
Absolutely.
Yeah. Okay.
Now, on your credit report, where do we find amounts owed? A lot of credit reports will have a summary page on the credit report where you can actually see your debts laid out.
Yeah.
If not, you want to go to the actual trade lines or the accounts on your credit report, and you want to look for account balance or balance amount, and that's where you will see what your actual debt load is on that trade line. Sometimes on the summary page, it'll give you a total of all the debt that you have. Okay, well that's about all we have today on amounts owed. CP, why don't you wrap up this episode?
Well, thanks for being here for episode 4, and if you need any more information, come see us at www.creditpuppet.com. Till next time, see you later.
Bye-bye.
Bye.
Good job, CP.
Oh, that was good. You know, I learned a lot. I didn't think about those things. You're so informative. I guess that's what you're certified.